So my name is Nishant. I work at a fund called K Partners, and again, actually little bit about K and what we do. My email is there, so share it with you again, and then feel free to note it down and drop me a note whenever you have any questions or if there's any way I can help. So here's a quick background. Myself, I'm basically doing my life to date of three separate aspects. I worked at two startups. The first one I founded, it's a music platform on the iPad, a company called Groupbug. I started it about a couple of years ago, raised around the funding from VCs and angels. Ran it for a little bit. This is the company based in Chicago, and then actually ended up moving to India to join the venture industry. Groupbug still exists today, but we're just raising our Series A, and so as a minority shareholder now, I help them work more on the sides, not as a full-time person. Before that, I worked at a startup called Twitter, which was doing advertising for Twitter, like way back in the day, Twitter was still early, and worked there for about a year, managed to run it into the ground, but still good experience. In terms of working, I worked at Microsoft, spent about 4 years there. Last role, actually worked with them both in the US and in Asia. Last role was in Singapore, where I was managing business development across Asia Pacific, which is about 16 countries for Microsoft, for the online business. And then before that, I spent a couple of years in the Valley with Morgan Stanley, working mostly with early stage technology companies. So Zappos of the world is when we were like 5 years. And then my education, I have a 3-degree bachelor's, master's in computer science and MBA. But the bottom line is before that, so it doesn't matter. So, as I said, before you start thinking of pitching to VCs and fundraising, it's useful to step back and say, what's driving VCs? Right? Because I think a lot of people, again, the simplistic view of the world is VCs are people with money. I want money, hence I go talk to VCs. I'll spam as many as I can. Few of them will reply back, I'll go meet them, I'll get funding, and everyone's happy. It's actually a little bit more nuanced. So I think it would be useful to talk about, how do venture economics work? Actually, it turns out, as you can imagine, VCs are institutional investors, right? It's my job, it's my day job to invest money. And the money is not mine. I myself raise money from others. So my goal is to take X and create 3 to 5X out of it. Right? So I essentially get benchmarked based on how much value I can create. And it's useful to kind of appreciate that as you start thinking about who's the right partner for you in terms of fundraising. So again, why know it? Of course, you don't want to, the better you understand the industry, the quicker you'll be able to tailor your fundraising efforts to the VCs. Fundraising by definition is not your core business. The more time you spend there is the less time you spend on your business. So making it quick is obviously always a good thing. So again, just quickly, how does the venture fund work, right? A venture fund, VC funds are typically structured as limited partnerships, LLC essentially, and what they do is they raise money every 3 to 4 years for a period of 10 years. So today I raise money from whoever, a bunch of different investors. I have to return that money in 10 years. So typically what VCs will do is they'll raise money, they'll invest that money over the next 3 to 4 years. And then over the last, from year 7 to 10, they start exiting the companies and return the money to whoever they took it from. And in the process, the goal is, if I took $1, I want to return $3 to $5 back on average. And just the general dynamics of the industry are, if VC throws money in 10 companies, 3 to 4 of them typically will go bust. Right? So I'll put 5 million and I'll get it back. Then about 2 to 3 of the companies will actually return whatever I put in. So I just get, if I put 5 million, I get 5 million, but after 5 years. And then there will be 1 or 2 companies in my portfolio of say 10, 15 companies that will actually generate super returns. So that generates something like 10x. I'll put in $1 million, they'll give me back 10 million. Also, in the example of Facebook, for example, 300-400 times whatever money was invested. Those are obviously very abnormal. But in general, the industry works on the premise that out of a collective pool of startups, while the majority will either fail or do average, one or two will be the super winners. So each VC that you talk to is optimizing for that. Now again, step back and say, I can't predict the future, right? So I actually don't know which of my company is going to be that super success. In which case, every company I invest in, I have to believe that this might be a super success. And hence, my bar to invest in companies gets judged on, is this going to be a super success or not? And so, if my return expectations that I laid out here are like 5 to 7x, so whatever money I put in, I want some big return on it. The model only works for large exits. And I'll go further down into what that means for you. And the model only works on significant stakes. So, if it's a $100 million exit, as in, you sell your company for $100 million, and I own only 5% of it, to VC, that's not interesting, right? Because I didn't get anything out of it. Again, if I'm only going to have 2-3 exits in a year, per year, then those better be the big ones. Small exits not that. So hopefully, even this, actually, I don't have questions again. What is the level of comfort with the topic? Does this generally make sense? Is there anything I can explain here? Because I think this will be built upon this there. Make sense? Okay. So what that then means is, if as a startup, you are not in a big market, right? Or you're very averse to dilution, right? You don't want to give a lot of your stake to VCs. Those typically can be roadblocks in raising venture capital. Right? Now again, remember that not every business has to be venture funded, not every business should be venture funded. There are a lot of perfectly good businesses that can run, that can create a lot of large interesting companies without getting venture funding. But if your goal is, I want to get venture, this is the general exit path that we see. Again, we go into kind of how VCs start picking companies, but generally, how do you decide what kind of VC fund to work with and how they categorize? Few different ways. So, typically VCs, the easy way to split VCs is looking at what stage they invest in. And again, today you guys are all, a lot of you are entrepreneurs here. As you start figuring out which VC to invest in, saying what is the stage that the VC invests in. Does the VC invest in very early stage companies or growth companies or very late stage companies? Will help you cut down your universe to fewer VCs with whom then you can have a much more tailored discussion. So, again, in the early stage, which is a very broad word, you can all, the goal should be, let me go back, look at what this VC has typically invested in the past. If I have if I don't have a product, if it's just an idea, and the VC has never invested in anything like that, odds are he might not be interested in your idea. In which case, maybe there's a better person who understands and appreciates where you are as a business in terms of stage, and talk to someone like that. The other one is, this is an obvious one. Again, if you're a healthcare company and you go to a VC who only invests in IT, you're only wasting your time. Right? As I said, the business is the focus, not this. So, really doing good homework before you start approaching investors. And again, all of us have, all investors will have their portfolios laid out on their web page, but just trying to get a sense of what have they invested in, how early or late have they invested in, will cut away half the email traffic time that you might otherwise end up spending. Corporate VC are an interesting breed, and more recently they've obviously become much more active. So corporate VC is someone like a Cisco Ventures or Intel Capital or now Microsoft, I think he also has some kind of fund where they will typically invest out of their balance sheets. Actually, it's the company's money that's getting invested, and generally it has some kind of strategic purpose to it. So, for example, Cisco wants to make sure that more data flows through the networks. They might invest in a video company or consumer video company that essentially then does create that data over time. So if you are, if you can identify corporate VCs that might be a good fit for you, then by all means go approach them. Since they're guided by strategic purposes, they're much more able to invest in startup that are relevant. So again, how do you pick a VC? As I said, for sector stage, number one. That should be a biggest filter. Make sure that there is a very strong correlation between where you are as a company and what you're doing versus what the VC is investing. The other is the investment cycle of the fund, and I won't go too deep into this, but essentially, as I said, VCs will raise money for 10 years. Right? If it's year 6 or 7, then a VC's ability to invest in a very early business goes down a lot. And the reason is, if only 3 years earlier, if you're a very early company, you might still require 5 to 7 years to mature the business to finally provide an exit. In which case, then the VC is not willing to invest from his fund at that stage. So if it's an early fund, if it's early days in the fund, the VC might still have a 7 to 8 year timeline and hence be more willing to invest in early business. The last two are actually very interesting. So again, compatibility of thought, I have to say, money is dumb, right? Money is the easiest thing in the world. If you're a good company, you will always get money. Like that will never be, even though it's hard and of course you still have to work through it. It takes 3 to 4 months, but you will typically find money. As a company and as an entrepreneur, if you really value yourself and what you created, you have to go for a valuation. Right? I mean, what is the VC providing to me beyond just cutting me a check? Because remember, the check is just a point. You still have a full business to build after that. And so, what are some things that VCs can help you with, and other than money, which again is the smallest? It could be helping you determine strategy. It could be helping you hire 2 good guys from Google. Right? It could be helping you create your board of directors. It could be, there's definitely this notion of enhanced credibility, right? If you get venture money, people start to think, you're a big company, you're venture money. So if you are, for example, selling to government clients, getting any kind of venture funding typically helps you close deals much faster because people suddenly associate the venture fund with you instead of it. So typically, these are something that again I've laid out with VCs will bring apart from money. And again, as you start talking to venture investors, it's good to ask all these questions around what will you give me? Money is good, but what do I get beyond money? Do you have any relevant networks in my industry that you bring along? This guy is going to be on your board. Is he able to share any kind of insights as you build the business? Those are good questions to ask as you start evaluating funds. And again, like anything else in life, there are obviously trade-offs. The biggest one, of course, is that now you have someone on the board. As a founder, you obviously can't make decisions only by yourself. So there's a board and you have to get consensus. There's also some reporting requirements that come in when investors come on the board. And it's mostly process. In some sense, it is a good thing, but it is additional overhead on top of so let's talk about a little bit about what is the life cycle of a startup and when does venture investing, when does raising venture capital really make sense. So I've tried to lay out time and maturity on the XY axis, and if this is kind of how over time as a company you mature, the first stage is kind of the ideation stage, right? When you have some kind of concept, you're thinking of building some kind of product, you build it, you launch it, you initial market feedback, you still try to figure out is this a valuable market or not. And typically at this time, you get money from friends and family, right? 3 F's is this, right? Friends, family, foods, you with money, it's an unproven concept. And you still kind of, you have some sense for potentially this could be big, but you actually don't know. And so that's the phase where you're trying to figure it out. The next is the seed stage. And again, in India, seed is basically capital which will start anywhere from 20-30 lakhs, go all the way to crore, 2 crore, something like that. But essentially, this is a stage where you kind of know that there is value in the business. Now you're just trying to build it out. You're trying to get early customers, run a pilot, get their feedback, and also trying to build some kind of a team. And so, this is when a seed fund might come in and kind of be willing to cut you a decently sizable but still smaller check to help you prove what you see is valuable in the market. Post this, then you actually start getting into the VC world. At which point, and again, those are the two boxes. The red is where VCs typically invest in. On the left, at the point, the notion is you're kind of validating the market. So you're trying to say, I've identified a problem. I can see it's a valuable problem. Now let me see, how much of a market can I create out of this. You're trying to, you generated commercial revenues. You have early customer wins. You're definitely building up your team, and I'll talk a little bit about why VCs care so much about team. But it's not just you and your best friend, it's actually a little bit more developed organization. At that stage, an early VC could come in and again, provide you capital as well as some kind of non-capital resources to help you build the business. And then further down, the growth, VCP is more around saying the business has been built, financials are clear, now you just need to accelerate it. So for example, today you're in one small part of India, now you want to be across 5 cities. A growth VC will come in and kind of essentially give you capital to expand the model, replicate the model essentially across multiple places. And so typically at this time you're profitable, right? So this growth VCs will only come in when it's a profitable but scalable business. And then the last is when all of us want to go, which is the IPO. At this point, of course, your source of funding is the public market. So again, net is always, there are at least 2 stages before VCs typically will come in, right? Friends and family, your angel, very early products, still trying to figure out is there value there. And then also the seed stage where you at least have some sense it's working, but the business is still not built out, the team is still not built out. There are a lot of risks still on the table. At this point, again, a seed round, both in terms of type of investor and in terms of volume of capital required. Seed might be a better bet for you rather than kind of going into a VC fund. So, going back to my word notion of, as you start thinking of VCs, what drives them? What is the biggest question they are asking as they're looking at one of your startups? Is this, can I get a large exit? Can I make a lot of money through this? Is this going to be the next Facebook or the next Instagram? I mean, maybe not. In India, we don't have those. But in general, can I put $1 there and get 5 or 10? And large is an ambiguous word. Large depends on a lot of different things. But how much money is the firm putting in? How big is their fund? What is the valuation at which you go in? There's a lot of moving pieces. So, and again, as an entrepreneur, you actually might not know a lot of these from the outside. So you can always ask both the VC but also people in the ecosystem around, is this what kind of exits have these guys to be gone after? And again, you might be able to basically get general signals around, am I a good match for the investor or not? Which is again, streamlining the process a lot. But what this does mean is, in terms of getting a large exit, what it does mean for you is, VCs will look at things like revenue and profit, exit, and again, revenue and profit not just definitely not today, but at least ability to get to that in the future. VCs will look at something like exit multiples to say, if I want a large, do people understand valuation in general? Or should I just quickly give you a general sense of how it works?
Please.
Okay, so typically what VCs do, since VCs are investing in typically unprofitable companies, right? And when I say unprofitable, I mean not just today unprofitable, but 4 years later you might still be unprofitable typically. So VCs hence tend to look at exits to say, what is the revenue multiple I might get out of this? So imagine a simple example. Let's say 4 years later, you have a 10 million revenue business. And let's say you are in the internet space. Now, if I look at the internet public companies today, they typically are valued, right? They're publicly traded in the markets. They're typically valued at like 5 to 7 times their revenue multiples. So VC might do that calculation to say, if your company could generate 10 million revenue in 4 years, maybe I should apply a 5 times multiple to that. To tell me then that this will be worth about $50 million if I were to exit it. Right? So once they use some kind of, this is an art, not a science, but they will use some kind of metrics to first of all determine what could you be worth in the future, and then based on that, apply to that what percentage of equity stake they need to hold in that for them to actually have a meaningful exit. And then based on that, they take all of it back to say, today how much do I need to do? Right? So for example, simple examples. Let's say your company worth 10 million in 5 years. And let's say the exit multiple for you is 5 times. So whenever you exit in the future, potentially it could be a $50 million exit. And let's assume the VC says, out of that 50 million, I want 25. Okay, so let's say the VC says, I want 10 out of it. Right? So I need to hold 20% stake in you at the time of your exit 5 years later. That 20% exit in 5 years means that today I probably need to own about 35 to 40%. Because as you raise funding, VCs get diluted and whatnot. So that's the general maths that the VC is doing in his head when he's talking to you to say, what is the right stake today? So that I can get an interesting return in the future. And so as an entrepreneur, that's something you should do also. Right? As you start thinking of, as you start talking to VCs, you get hopefully indications of interest. You should have some sense of where is this guy going to end up at in terms of meaningful exit. And part of your job is again to prove that the future is very bright. Because if the pie is very big, it doesn't matter if you own a small piece or a large piece, everyone makes money. So pitching the story and pitching the value, the value of the business directly impacts how much the VC values you and also how much the VC then gets a stake in you.
What are the last strategic industries? The AdMob example you mentioned?
Hi, so this is interesting. So it doesn't happen much in India. So in the US, what happens is the acquisition ecosystem is so strong. What people do is you can start companies knowing that you will get acquired by a strategic guy, right? So for example, if you were, 5 years ago, if you were in the US and you knew mobile advertising and you knew that Google was struggling to monetize on mobile, you would have started a mobile ad company like an AdMob, knowing that Google would acquire. And it happens. Like a lot of people, what they do is they'll actually start identifying product holes in product roadmaps of larger corporates and then create startups around it. And the notion there is either you beat them, in which case you have a big company, or you do something interesting, in which case you get acquired. Right? So that's what people do. AdMob will do it. Actually, when I went to school in the Valley, one of my teaching assistants, this guy used to, he was a PhD student or something, he sold 2 companies to Google while I was still in school, and multi-million-dollar exits. And just because this guy's PhD thesis was in and around what Google was doing at that time, created a couple of interesting products that got acquired. So I used to joke that I'm still worried about getting A plus and B plus. There are many millions of dollars. But clearly someone knows how to optimize. So general, what I wanted to do is, sorry.
In that case, the revenue is not that relevant. If you think that it's going to be strategically,
It's correct. That's exactly. If you can actually identify the interesting opportunity, they actually don't care at all about it. Because actually oftentimes what happens is they take whatever you have and then they just really kill it and integrate it into their own product.
yeah.
So then the notion is just getting deep with fitting into the roadmap. Right? In which case, then you go out, you meet the product managers every 3 months, you make sure they tell you what they're focused on, and then you start tailoring it. But yeah, and those typically actually tend to be very good. Generally, tend to be great outcome, right? So Instagram is a great example. You're not a penny of revenue, right? And got bought for $1 billion only because number one, Facebook just went through an IPO, so they have a lot of cash. B, more than half of their usage now is on the mobile, where they actually don't know how to monetize. And so this comes directly in the intersection of that, which is honestly great.
You personally believe Instagram valuation was insane?
Sorry?
Do you personally believe Instagram valuation was insane?
Yeah, so insane is I mean,
So you should
valuation is just, the market determines it. I mean, I might think it's insane or not, but, whatever clears the market is the right price. For you and me, this, for Facebook, if they can create a few $1 billion business out of it, it will be the rounding up. So, no, as a VC, I actually do want such valuation, so I don't think it's So I'm going to list a few key characteristics that VCs tend to look for. And again, in the next slides, I'm going to go through some of these. As I said, front and center, ask any VC what do they care about team, and why is team actually there is a very clear reason beyond just the hype. When we meet young companies, 99% of the story we hear is in a blog point, right? So my ability to vet the story is limited, right? I mean, I can also make a slide, you can also make a slide, it doesn't matter. But what I can actually understand, where to go after is the team. Is it a good team or not? Is the team, do I think the team will be able to capture this opportunity or not? Do they have the mental acumen? Do they have the perseverance? Those are questions I can today ask and get an answer and get comfort around whether I believe the answer. So hence VCs, first and foremost, every VC will invest behind a team, and only then we look at a market, right? So that's the second thing people go after. VCs tend to look for, which is, is this a large enough opportunity or not? And again, if you think about it, running a business is hard, creating a business is even harder. Everyone will make mistakes. If you're in a large enough market, that at least lets you do a lot of mistakes, but still have a relevant business or an interesting business in 4 or 5 years. And so, two kind of markets, and again, there's multiple examples I just laid out too, that VCs tend to look for. One would be a nascent market, right? So, think 4G, for example, right? Where again, there's nothing there today. You kind of have some sense of 4G is coming in 6, 9, 10 months. So, if there's a startup that is kind of doing some work today and shows some interesting promise when 3G is launched, that might be a bet some investor might be willing to take. To say, listen, I see a big market, I see no one's there, this guy can come in and quickly build a business. The other is like an existing market where you have this some very fundamentally disruptive technology, right? So think, the good old days where Microsoft and package software, suddenly Salesforce comes in and creates software as a service, fundamentally shifts how the product is getting sold, how the customer is using the product. That's another interesting point. It's a big market, there's a customer who's willing to spend, and now you're getting something better. Another interesting opportunity. Then the next few things kind of go into a little bit more of the qualitative stuff in my mind. And again, you could have a great team, you could have a great market, but there could be 20 other people doing the same thing you're doing. So the question then to ask yourself, and I think a lot of this is meant to be, you should ask yourself this before the investor asks you, why are I doing? I mean, is it because what advantage do I have today that allows me to do, win in this market when 15 other people are doing this? And again, some of this is, comes from the fact that it's not a 1 month or a 1 year game. It's a 3, 5, 7 year game. And so why will you be the one who will be there standing at the end? The next notion of scalability again is, you hear a lot of VCs talk about, is the business scalable or not? Essentially the notion is, as I said, VCs raise some amount of money, so they have limited capital that they can invest in their companies. They're looking for capital efficiency, right? They're not looking for, if you're going to set up a factory, that's